back. Well, the Central Bank of Nigeria last week revised the cash reserve ratio of merchant banks to 10% from 32.5%. CRR is a share of a bank's total customer deposit that must be deposited with the central bank. Let's find out the rationale for this reduction. Joining me now is Mr. Tajuddin Ibrahim, Director of Research and Strategy, Chapel Hill, Denham, joining me via Zoom. Great to have you on the show.
Thank you for having me on the show.
So the CBN has definitely been busy the past few weeks. Now is the cash reserve ratio for merchant banks revised downward to about 10%. How do you see this development?
I think the development is a reflection of what Nigerians should expect in the next couple of quarters, because it is an indication of a loose monetary policy stance by the central bank. Because if you look at the cash reserve ratio, we all will understand that it is an indication of liquidity management in the financial system. Now, if the central bank is cutting down from 32.5% to 10% without necessarily sitting at the monetary policy committee meeting to make this decision, what it means is that the CBN is, single-handedly, taking that decision to go from tight monetary policy to what we can consider as a loose or accommodative monetary policy stance. I think that is what it implies, and Nigerians, generally speaking, should be expecting an improvement in business activities as liquidity improves in the banking sector, and also which will have impact on the economy as a whole. Those are my views.
Banking system, when the CRR increased to about 32.5% from 27.5%. Why do you think the CBN is targeting merchant banks for this reduction in CRR? Because I know merchant banks normally target high net worth individuals and international entities, like the big ones on the table. Why do you think they're targeting merchant banks?
Or let me say the lower subsector of the banking sector, because the merchant banks are not as financially buoyant as the large commercial banks. So if they are starting from the merchant banks, the impact in terms of liquidity inflows into the financial institution will largely be limited, and it is a reflection of let us start from the the lower parts, and then over time they may consider extending it to the other subsectors of the banking space as a whole. But I think it is starting on a slow note, in my view.
And the CRR was increased to tackle rising inflation by reducing liquidity. Inflation still above 22%. Last I checked. What are the potential implications of this CRR revision on the inflationary pressures in Nigeria?
So I think the impact of this CRR reduction for the merchant bank will be limited on inflation for a couple of reasons. Number one, we consider the fact that our inflation in this country is not necessarily demand pushed. It is largely driven by cost. So when we have more liquidity flow in the merchant bank space, that will not necessarily result in an increase in inflation. That is one. The second thing to bear in mind is that the merchant banks they are fewer when you compare them to the commercial banks, and they also have much smaller balance sheet compared to the big commercial banks. So any freedom of liquidity in that space is unlikely to negatively impact inflation. Where we could see The impact on inflation is where we have, the large commercial banks, having more of their liquidity being made available to them, and then they go to chase the foreign currency, US dollars in this case. Then, we may begin to think about the impact of inflation as a result of higher system liquidity. But for now, I see little or no impact for these merchant banks, in my view.
All right, we're still all eyes on that June inflation data. We're all counting down to that one right here in Nigeria. But it seems this government is prioritizing, economic growth over inflation. How can the government make this plan work without stoking inflation even more? Because salary earners, pensioners are feeling the heat right now.
So I think one way that they can make it work, is to ensure that whatever flows from the banking sector in terms of an increase in liquidity is not allowed to chase US dollars. If, the liquidity free flow in the banking sector is allowed to chase US dollars, what it means is that FX rate at the parallel market will be going higher, and that will lead to an increase in the cost of goods and services, and eventually it will lead to higher inflation. And let us mind, those two words. I said the costs, of goods and the cost of services. So which means we are looking at costs, and we are also looking at foreign currency. When commercial banks have huge liquidity in Naira in their position, some of them tend to chase the US dollars at the parallel markets, and that results in higher exchange rate and eventually, results in higher, prices of goods and services, particularly those that are imported, and you will see the impact on inflation. So what they have to monitor is to ensure that any form of liquidity flows in the banking sector is not allowed to chase the US dollars. If they can deal with that, then we will not see the impact on inflation, and we will see more of economic activities on the back of higher liquidity flow in the financial system. Those are my thoughts.
Yeah, definitely a lot to do there. But how do you see markets reacting to this? First trading day today. How do you see, especially that financial services counter? How do you see it reacting to this?
So for the financial services counter, one thing we have to bear in mind is that the banks that are listed are not affected as we speak, because those are largely speaking the big commercial banks, talking about the tier 1 banks, the tier 2 banks, and also the tier 3 banks. We don't have much of those merchant banks listed. So we should still see investors confidence and interest in the banks remaining strong this week, particularly bearing in mind that last week was a week of profit taking for investors on most of the banks, that some of them lost 20%, 25% in 1 week. It is a good thing because it allows investors to take profits on their investment. So this week, we could begin to see a re-rating. We have no negative news in the sector. All we have is stability, in my view.
Right, investors definitely looking out for the next market-moving news. Thank you so much, Mr. Tajuddin Ibrahim, Director of Research and Strategy, Chapel Hill Dams. Great having your perspective today.
Thank you for having me.